Hello everybody, at this time I'm talking about mutual funds. A mutual fund gathers money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. These funds are the cornerstone of their retirement savings, offering professional management and built-in diversification that would be difficult to achieve on their own. In a mutual fund, investors pool their money to buy assets together, benefiting from shared costs and professional expertise, rather than buying individual stocks or bonds. You buy shares in the fund itself, becoming partial owners of all its holdings. When you invest in a mutual fund, you're essentially hiring professional money managers to make investment decisions on your behalf. These managers research opportunities, select securities, and monitor performance according to the fund's stated objectives, whether that's aggressive growth, steady income, or matching a market index. And then we move to benefits of investing in mutual fund. The first benefit, investors with smaller budget can do investment diversification in their securities to minimize the risk. For example, an investor with limited fund can have a bond portfolio, which is impossible to do if he or she does not have big budget. By mutual fund can be collected in big amount to make it easier to diversify both for capital market instruments and money market. It means that the fund is invested in various types of instruments such as deposits, stocks, and bonds. And then second benefit, time efficiency. Since the fund invested in the mutual fund is managed by a professional fund manager, investors do not need to monitor their investment performance all the time. And then the third, mutual fund helps the investor to invest in capital market easier. Determining which good stocks to buy is not easy. It needs specific knowledge and experiences which some investors don't have. And then how do mutual funds work? Mutual funds mainly work by pooling investors' money in a diversified portfolio of stocks, bonds, or other assets. A fund manager oversees and controls the portfolio, making decisions on asset allocation based on the fund strategy. These professionals have rich expertise, and their objective is to maximize returns on your investment. Mainly, mutual funds are of two types known as actively managed and passively managed. The actively managed funds need a fund manager who carefully analyzes and chooses investments to maximize the investments. Such funds need careful research and expertise, whereas The passive funds majorly aim to replicate a specific market index. When you choose to invest in mutual funds, you can get benefits like diversification, professional management, and liquidity. Investors can choose funds based on their financial goals, risk tolerance, and investment horizon. And then we move to key characteristics of mutual funds. The first, they are run by professional money managers who decide which securities, like stocks, bonds, etc., to buy and when to sell them, with the goal of giving you the best return on your investment. And then second, you get exposure to all the investments in the fund and any income or losses they generate. And then third, they typically have low minimum investments and are traded only once per day at the closing net asset value. And fourth, they offer a wide variety of investment strategies and styles. And then we move to constraints for individuals investors. The first, lack of expertise to understand and forecast market trends. And then the second, inability to accurately monitor the rapidly changing market. Third, lack of time for an in-depth analysis of the various investment avenues or instruments available in the market. And fourth, inability to diversify by investing in more than one company shares. And then how mutual funds earn a return. When you invest in a mutual fund, your investment or the fund's value can increase from three sources. The first, dividend payments. When a fund receives dividends or interest on the securities in its portfolio, it distributes a proportional amount of that income to its investors. When purchasing shares in a mutual fund, you can choose to receive your distributions directly or have them reinvested in the fund. And then second, net asset value or NAV. As the value of the fund increases, so does the price to purchase shares in the fund. This is similar to when the price of a stock increases. You don't receive immediate distributions, but the value of your investment is greater, and you would make money should you decide to sell. And then third, capital gain. When a fund sells a security that has gone up in price, this is a capital gain. And when a fund sells a security that has gone down in price, this is a capital loss. Most funds distribute any net capital gain to investors annually. And then we move to types of mutual funds. The first, money market funds. These types of funds invest primarily in treasury bills and other high quality, low risk short term investments, offering stability, minimal risk, and preservation of capital. Money market funds deliver returns in the form of regular monthly interest income that are typically higher than these of a traditional bank account. Investors looking to meet short-term goals or access funds in case of emergency often choose money market funds as an investment solution. And then second, balanced funds and portfolio solutions. Balanced funds hold a combination of equities, fixed income, and money market investment. The portfolio manager adjusts the assets mix based on the objective of the fund and their view of the economy. Investors receive distributions in the form of interest, dividends, and capital gains. And then third, fixed income funds. By investing in fixed income securities such as mortgages, bonds, and preferred shares, fixed income funds can provide a predictable source of income and help to preserve capital. These funds typically distribute interest, income, and provide potential for capital gains. Fixed income funds may also be used as a way to diversify an investment portfolio. And fourth, equity funds. Equity funds invest in the stocks of public companies. These companies range in size from large to small or both and can be located in US or all countries. I think it is enough. Thanks for watching.